Imagine a scenario where the U.S. economy is on the brink of a significant shift, and the Federal Reserve is faced with a daunting decision: to cut interest rates or not. This is precisely the situation that Federal Reserve Bank of San Francisco President Mary Daly finds herself in, as she reveals that the time for rate cuts is nearing, and it may require more than just 2 cuts. But here's where it gets interesting. Daly's statement comes after the Fed's decision to leave short-term borrowing costs unchanged, despite some of her colleagues and President Donald Trump pushing for a cut. So, what's behind this potential change of heart, and what does it mean for the U.S. economy? Let's dive in and explore the reasoning behind Daly's statement. According to Daly, the U.S. job market is softening, and further weakening would be unwelcome. The latest Labor Department report showed that U.S. employers added only 73,000 jobs in July. And massive revisions to previously reported data revealed that only 33,000 jobs were added in the 2 prior months. While these figures don't necessarily indicate a precariously weak job market, they do suggest that the labor market is losing steam compared to last year. And this is the part that most people miss: the unemployment rate, which ticked up just 0.1 of a percentage point in July to 4.2%, is often a more informative indicator than raw employment numbers. However, when looking at a broad dashboard of labor market measures, there is evidence that the labor market is softening quite a bit. Daly emphasizes that she would see further softening as an unwelcome result, and while she's comfortable with the decision made in July, she's increasingly less comfortable with making that decision again and again. But here's the controversy. Some might argue that the Fed is being too cautious, while others might say that they're being too aggressive. What do you think? Should the Fed prioritize keeping inflation in check or focus on supporting the labor market? The fact that there are no signs of persistent tariff-driven inflation adds another layer of complexity to the decision. If the Fed waits too long to be certain that tariff-driven price increases won't seep into inflation, they risk being too late to move. This is a classic trade-off, where the Fed needs to balance the need to put downward pressure on inflation with the need to support sustainable employment. As Daly puts it, the Fed is approaching a trade-off space where they need to make a judgment about where policy needs to be to achieve these competing goals. So, what can we expect from the Fed's upcoming policy-setting meeting in September? While a September rate cut is not a guarantee, Daly says that every meeting going forward is a live meeting to consider policy adjustments. The 2 quarter-point interest rate cuts penciled in for this year still look like an appropriate amount of recalibration, but the timing and permutations are less important than the fact that they happen at all. And this is where it gets really interesting. Daly thinks that the more likely scenario is that the Fed might need to do more than 2 rate cuts, especially if the labor market looks like it's entering a period of weakness and inflation remains subdued. But what do you think? Do you agree with Daly's assessment, or do you think the Fed should take a different approach? Share your thoughts in the comments below. As we navigate this complex economic landscape, one thing is clear: the Fed's decision will have far-reaching implications for the U.S. economy, and it's essential to stay informed and engaged in the conversation. So stay tuned for further updates, and let's continue the discussion.